Internal control and management reporting. Part A. Justify the need for reports on internal controls to shareholders. Internal control is an important tool for organisations and different stakeholders such as shareholders, debt providers, employees, customers, and government and regulators. For shareholders, internal controls help them by reducing incidents of fraud and error in organisations, which ultimately ensure that their investment is protected. Controls also manage the risks faced by the organisation, thus reducing the overall risk faced by the investors. However, controls cost money to design, implement and monitor. This reduces the values of shareholders' investment. Therefore, shareholders prefer to have a balance of controls, so more controls over high-risk areas and fewer over areas where they are less exposed. Part B. Discuss the typical contents of a report on internal control and audit. The report on internal control and audit should contain and concentrate on the next 4 points: the risks which organisations are facing, strategies to identifying, evaluate and manage, effectiveness of the management and internal control systems in the management of the risk, in particular how risks are monitored and how any deficiencies have been dealt with, what actions are being taken to reduce or mitigate the risk found in the organisation, whether the results indicate that internal controls should be reviewed more frequently. The UK's Institute of Internal Auditors also recommends that the board should consider the Code of Business Conduct in order to carry out an effective review of internal controls. The organisation's Code of Business Conduct includes confirmation that line managers are clear about their objectives, overall results of a control self-assessment process by line management or staff, confirmation about the operation of a system or specific transactions called a letter of representations on internal control from line management. Report from the Audit Committee on key procedures that are designated to provide effective internal control. Reports from internal audit on audits performed. The Audit Committee's assessment of the effectiveness of the internal audit. Reports on special reviews commissioned by the Audit Committee from the internal audit or others. Internal audit's overall summary opinion on internal controls. External auditors report on deficiencies in the accounting and internal control systems and other matters, including errors identified during the audit. Intelligence gathered by board members during the year. A report on avoidable losses by the Finance Director. A report on any material developments since the balance sheet date and up to the present. The Board's proposed wording of the Integral Control Report for publication. Part C. Assess how internal controls underpin and provide information for reliable financial reporting. Financial controls focus on key transactions areas with an emphasis on safeguarding of assets, the maintenance of proper accounting records, and reliable financial information. Financial controls need to ensure that assets and transactions are recorded completely and accurately in accounting records, entries are posted correctly within accounting records, the cut-off is applied correctly so that transactions are recorded in the correct year, the accounting system can provide the necessary data to prepare the annual report and accounts. The accounting system should provide the data as required and should be organised to supply the necessary data on time and in a usable format, which underpins the accounts and other parts of the annual report.